There is a lie being told on Wall Street right now. It is a $682 billion lie. If you turn on the television, the experts will tell you that the financial relationship between the United States and China is stable. They will point to the massive amount of debt Beijing still holds and tell you to sleep soundly. But they are looking at the wrong number. The story is not about the money that is still there. The story is about the money that has vanished. In the shadows, away from the headlines, the greatest capital evacuation in history is taking place. China is not just selling American debt, they are dumping it. They are realizing record losses to escape the dollar system before the doors slam shut. This is not a portfolio adjustment. This is pre-war logistics. And while everyone is watching the stock market hit new highs, the smart money is quietly sprinting toward the emergency exit. Welcome to FinGraphy. Today, we are going to expose the Belgium Secret, a mystery involving a tiny European country that is somehow buying enough United States debt to rival a superpower. We will uncover the tragedy of Japan, America's loyal ally, who is being forced to cannibalize the United States bond market to save its own dying currency. And most importantly, we will answer the trillion-dollar question. If China is cashing out, where is the money going? It is moving into the three pillars of a war economy: gold, oil, and copper. The music has stopped. The exits are closing. Let us find out if you are prepared for what comes next. To truly understand the gravity of this situation, we must first learn to read the flight recorder of the global economy. It is a document called the Treasury International Capital Report, or TIC data. For 40 years, this report told a boring, consistent story of globalization. It was a perfect loop. Step 1. American consumers buy cheap goods from China: your iPhone, your sneakers, your furniture. Step 2. China receives billions of United States dollars in payment. Step 3. Instead of letting those dollars gather dust, China recycles them back into the United States by buying treasury bonds to earn interest. This loop was the engine of the modern world. It allowed America to borrow cheaply to fund its wars and its welfare. It allowed China to build its factories and lift its people out of poverty. It was a marriage of convenience. But today, the divorce papers have been signed, and it is getting ugly. If we analyze the TIC data for the last 24 months, the trend line is catastrophic. It is not a gentle slope downwards. It is a cliff. China is dumping bonds at a pace we have never seen before. Now, I hear the skeptics. They say, FinGraphy, you are being too dramatic. Maybe China is just rebalancing its portfolio. Maybe they just need cash to prop up their own economy. Let me explain why that theory is wrong. You have to look at the price. The United States bond market has just gone through its worst crash since the Civil War. Because the Federal Reserve raised interest rates so quickly to fight inflation, the price of existing bonds collapsed. If you are a rational investor, this is the worst possible time to sell. You would hold those bonds until they mature so you get your full principal back. Selling now means you are voluntarily setting fire to your own wealth. Why would Beijing do that? Because they are calculating the geopolitical risk premium. They looked at what happened to Russia in February of 2022. They saw the United States and Europe freeze $300 billion of Russian central bank reserves in a single weekend. That was the moment the rules of the game changed forever. China realized that United States Treasury bonds are not risk-free assets. They are political hostages. Beijing knows that the moment they make a move on Taiwan, or the moment a kinetic conflict starts in the South China Sea, that $682 billion becomes worthless paper. It becomes a weapon that Washington can turn off with a switch. So, the Chinese Communist Party made a cold, calculated decision. It is better to lose 20% of the value now and get the cash out, than to lose 100% later when the sanctions hit. However, this creates a massive mathematical problem for the United States Treasury. The United States government is currently running a deficit of $2 trillion a year. They need to sell more debt than ever before. But their biggest customer, China, is selling, not buying. If supply is exploding and demand is collapsing, the price should crash, and interest rates should spike to 10 or 15%. That would destroy the American economy instantly. But it has not happened yet. Why? Because a mysterious buyer has stepped in to save Uncle Sam. This brings us to the most bizarre anomaly in the global financial data. Let us look at the map. There is a small country in Western Europe called Belgium. It is famous for chocolate, beer, and being the headquarters of the European Union. It has a population of about 11 million people. Its entire economy, or GDP, is roughly $660 billion. Yet, if you look at the United States Treasury data, Belgium is listed as holding nearly $500 billion in United States debt. Think about that ratio. Does this make any sense to you? Is the Belgian government taking nearly 70% of its entire economic output and betting it all on American bonds? Of course not. That is mathematically impossible. So, what is really going on? The answer lies in a building in Brussels called Euroclear. Euroclear is what we call a custodian. Think of it as a giant, anonymous Swiss bank vault for the world's central banks. When a country wants to buy or sell assets without revealing its identity to the public, they often do it through a custodial account at Euroclear. When the TIC report says Belgium, it does not mean the country of Belgium. It means anonymous account holders in Belgium. This leads us to the theory of stealth quantitative easing. This is the alpha that Wall Street insiders whisper about but rarely say on television. We know that the Federal Reserve is officially engaging in quantitative tightening, meaning they are claiming to sell bonds to fight inflation. We know China is selling bonds. We know Saudi Arabia is selling bonds. If the biggest players are all selling, who is buying? The theory suggests that the Federal Reserve, or a consortium of Western central banks, is using Euroclear as a proxy to buy up the excess debt. It is a shell game. Imagine you are trying to sell your car, but no one wants to buy it. You cannot just buy it yourself, because that looks pathetic. So, you give your friend some money under the table, and you tell him to pretend to be a stranger and buy your car at the full asking price. To the neighbors, it looks like a legitimate sale. It looks like your car is valuable. But in reality, you just bought your own car back to keep the price up. That is what is likely happening in Belgium. It is a sophisticated accounting trick designed to hide the fact that global demand for United States debt is evaporating. But here is the problem with magic tricks. They only work until the audience figures it out or until you run out of money to give your friend. And right now, the United States is running out of friends. Because even their best friend, Japan, is starting to panic. If the story of China is about strategy, the story of Japan is about tragedy. Japan is America's closest ally in the Pacific. They are also one of the largest holders of United States debt, owning over $1.2 trillion. For decades, Tokyo has been the loyal piggy bank for Washington. Whenever the United States needed money, Japan was there to buy the bonds. But loyalty has a limit, and that limit is survival. Right now, Japan is facing a currency crisis that threatens to destroy its standard of living. The Japanese yen has been crashing against the United States dollar. It has lost a massive percentage of its value. Why does this matter? Because Japan imports almost everything. They import their energy, their food, their raw materials. When the yen crashes, the price of gas, electricity, and rice in Japan skyrockets. The Japanese people get poorer every single day. To stop the bleeding, the Bank of Japan has to intervene. They have to prop up the yen. And to do that, they need to sell dollars. Where do they get the dollars? They have to sell their United States Treasury bonds. This creates a terrifying doom loop, a vicious cycle that neither side can stop. Let me break it down step by step. Step 1. The Federal Reserve keeps interest rates high to fight its own inflation. This makes the dollar very strong. Step 2. The strong dollar crushes the Japanese yen. Step 3. Japan panics. To save the yen, they are forced to sell United States Treasuries to get cash. Step 4. Japan selling treasuries floods the market with more debt, which pushes United States interest rates even higher. Step 5. The dollar gets even stronger, the yen gets even weaker, and the cycle repeats. It is a death spiral. America's policies are killing Japan's currency, and Japan's survival tactics are killing America's bond market. This is why the Belgium Secret is so critical. The United States has lost its real buyers. China is leaving because of war preparation. Japan is selling because of economic desperation. The Bag Holder Alliance, the group of nations that used to fund American spending, is fracturing. The United States is increasingly alone, printing money to buy its own debt through secret channels in Europe to keep the illusion alive. So, we have established that the smart money is fleeing the paper dollar system, but money is energy. It cannot be destroyed, it can only change form. If China is taking out over $680 billion, and likely much more in reality, where are they putting it? They are not stuffing cash under a mattress. They are moving from the financial economy to the physical economy. They are preparing for a world where digital numbers do not matter and only physical commodities ensure survival. Let us follow the money trail to the first pillar of the war economy: energy. Napoleon Bonaparte once said that an army marches on its stomach. In the 21st century, an army marches on diesel and jet fuel. You cannot run a tank, a fighter jet, or a destroyer without refined hydrocarbons. If you want to know if a country is preparing for war, do not listen to what their diplomats say at the United Nations. Watch their oil tankers. Right now, there is a massive, glaring divergence happening in the global energy market. The United States is doing something dangerous. To keep gas prices low for voters during election cycles, the administration has been draining its Strategic Petroleum Reserve, or SPR. They have sold off millions of barrels of emergency oil. The SPR is now hovering near 40-year lows. The United States is literally emptying its emergency gas tank to win political points. China is doing the exact opposite. Despite all the reports you hear about the Chinese economy slowing down, factories closing, real estate crashing, their oil imports are hitting all-time record highs. Think about that for a second. It is a data anomaly. If your factories are running at half capacity, why do you need record amounts of oil? If your people are driving less because of a slow economy, why are you importing more gasoline than ever before? The answer is stockpiling. China is using the liquidity generated from selling United States Treasuries to buy millions of barrels of crude oil. They are filling every storage tank, every underground cavern, and every reserve facility they have. And here is the key detail. They are not buying this oil from the United States or its allies. They are buying it from Russia, Iran, and Venezuela. And they are paying for it in yuan, bypassing the United States dollar entirely. This serves a dual strategic purpose. First, it secures the physical molecules needed to power a navy and an air force in the event of a blockade. If the United States Navy shuts down the Strait of Malacca, the choke point through which most of China's energy flows, China needs enough oil on the mainland to keep its war machine running for months or years. Second, it strengthens the petro-yuan ecosystem. It proves to the global south that you do not need the United States dollar to trade energy. They are trading paper promises from the United States Treasury for liquid energy from the axis of resistance. But energy is just the fuel. To build the weapons, to build the infrastructure of war, you need materials. You need the metal that connects the entire digital world. This brings us to the second pillar of the rotation: copper. In the investing world, we call copper Dr. Copper. Why? Because it is said to have a PhD in economics. Copper is used in everything: housing, electronics, cars, power grids. So, usually, the price of copper predicts the health of the global economy. If the economy is booming, we build more houses, and copper demand goes up. If the economy is crashing, construction stops, and copper demand goes down. We know for a fact that China's real estate market is in a coma. It is a disaster zone. Giant developers like Evergrande and Country Garden have defaulted. Construction cranes are sitting idle across Chinese cities. So, by all traditional logic, China's demand for copper should be plummeting. But it is not. It is surging. Imports of copper ore and concentrate into China are defying gravity. They are at record levels. This is the smoking gun that proves the war economy thesis. If they are not using the copper to build houses for people to live in, what are they building? They are building the things that destroy houses. Copper is the second most important strategic resource in warfare, right after oil. A single nuclear submarine requires massive tonnages of high-grade copper for its piping and electrical systems. A guided missile is packed with copper circuitry. Drones, radar systems, artillery shells, they all require copper. Even the bullets used by infantry soldiers are jacketed in copper alloys. The disconnect between China's crashing real estate market and its booming copper imports is the clearest signal we have. They are shifting their entire industrial base from civilian construction to military production. They are taking the dollars they extracted from the United States bond market and swapping them for mountains of copper ore from Africa and South America. They are physically moving the metal inside their borders. Once that copper is sitting in a warehouse in Shanghai, it is sanction-proof. The United States Treasury cannot freeze a pile of metal. They are trading credit risk for commodity security. And this rotation brings us to the final and most dangerous pillar of their strategy, the one that threatens the existence of the United States dollar itself. The third pillar is gold. Gold is often dismissed by modern economists as a barbarous relic. They say it pays no interest. They say it is just a shiny rock. They say digital currency is the future. But in a war, gold is king. For 14 consecutive months in this new cycle, the People's Bank of China has been relentlessly buying gold. They are adding tons of it to their reserves. But insiders believe the official numbers are a joke. They are likely underreporting their purchases by a massive margin to avoid sending the price to $3,000 an ounce before they are finished buying. If you look at the data from the Shanghai Gold Exchange, the withdrawal numbers suggest that China is vacuuming up the global supply of physical gold. They are paying a premium, buying gold at a higher price in Shanghai than it trades for in London, just to get the physical bars delivered to China. Why are they so obsessed with gold? Because gold is the only financial asset that is not someone else's liability. If you hold a United States Treasury bond, you are relying on the United States government to pay you back. You are trusting your enemy. If you hold a euro, you are trusting the European Central Bank. If you hold gold, you rely on no one. You trust physics. It is a bearer asset. It has no counterparty risk. This is the sanction-proofing strategy. China watched the United States weaponize the dollar. They know that if war breaks out, the SWIFT banking system will be used as a weapon. The United States will try to cut off China's ability to trade, but they cannot cut off gold. If the digital dollar system is turned off, nations can still settle trade imbalances using physical gold. It is the universal language of value that has existed for 5,000 years. By dumping billions of dollars of paper debt and moving that wealth into physical gold bars stored in deep vaults, China is effectively immunizing itself against financial warfare. Furthermore, this supports the growing rumors of a new BRICS currency unit, a currency that is not backed by empty promises, but by hard assets. While the West prints fiat currency to solve every problem, causing inflation and devaluing your savings, the East is quietly returning to the gold standard. They are building a fortress of value, and they are using American dollars to pay for the bricks. So, let us step back and look at the full picture. The exit from United States debt is not just a boring financial statistic. It is a siren. It is a warning shot fired across the bow of the global economy. China is liquidating the old world order from its balance sheet. They are selling the trust and buying the truth. They are selling paper and buying oil. They are selling promises and buying copper. They are selling debt and buying gold. Meanwhile, who is on the other side of this trade? Who is the bag holder? It is the unsuspecting pension funds. It is the retail investors who are still following outdated advice, holding a 60-40 portfolio of stocks and bonds. It is the people who believe that the government can print money forever without consequences. And it is the Belgium accounts, the shadow mechanisms trying to hold up a crumbling ceiling. The question you need to ask yourself is this: if the smart money, the sovereign wealth funds, the central banks, the people with the best intelligence in the world, are getting out of paper assets and moving into hard assets, why are you still doing the opposite? This is the great capital rotation. We are moving from a world of financialization to a world of tangible scarcity. In a kinetic conflict, you cannot eat Bitcoin and you cannot shoot a treasury bond. The things you can touch, hold, and use are the only things that matter. Do not be the last one to realize the music has stopped. The $682 billion was just the beginning. The exit doors are still open, but they are closing fast. This is FinGraphy. We read the data so you do not have to. Stay skeptical, stay prepared. And remember, in the game of empires, money always moves before the armies do.